Hey everyone, welcome back to the Venture Best Spotlight, the podcast series presented by Venture Best. Here in the Venture Best Spotlight, we feature exciting and innovative guests from venture markets throughout the United States, featuring both our incredible clients and friends of the firm. Venture Best is the Venture Best practice group here at Michael Best and Friedrich LLP, focusing on emerging companies, startups, and venture capital. Today's podcast is hosted by me, Evan Lonergan, and Venture Best partner, Galen Mason. Galen, I'll kick it over to you for the first question.
Thank you. Well, I thought we'd do quick intros and background. Today's focus is on AgTech and AgTech investing and running a company in that space. We've got Rob Schultz and Corbett Kull. Corbett, Rob, you guys hear me do this a lot inside the firm or meeting with other people as you grow your business. Could you do I call it the 6-second intro or maybe you go 11 seconds, but just a quick background?
Sure, I'll start. Nice to meet everybody. Rob Schultz. I'm a managing partner with Serra Ventures, and I'm located right outside of Park City, Utah.
And I'm Corbett Kull, CEO of CamoAg, and located in the suburbs of Chicago.
Corbett, what does Camo do? Could you give a quick snapshot on that?
Sure. So CamoAg is a vertical SaaS software company for agriculture. One of the things that makes us different is we don't sell to farmers. We sell to people who sell to farmers. So this could be anyone from an ag lender to somebody selling seed, crop protection, or even an ag retailer. I guess a tractor company could also use the CamoAg platform.
And it's a SaaS product?
SaaS product. Predominantly, per user, per year fee. We're typically working with larger enterprises that could have anywhere from 25 to several hundred seats of our software.
Okay, and then could you just give us a snapshot of your background, and then also kind of how it came into ag, and then I suppose asking a multi-part question here, how that ties into venture funding. Camo is, of course, on the venture background, and that'll probably lead us back to Rob in a second on what they're doing at Serra.
Sure, I may have to ask you what all those questions were again.
How did you get in? How'd you get into being a technology founder? And tell us a little bit about the venture path of Camo.
Yeah. So I'm an engineer by training. Started my career out many years ago at Motorola. Always had the entrepreneurial bug, I guess, and starting companies many years ago. In terms of getting into agriculture, I ended up, I had a very good friend that I used to work with that grew up on a farm in Northwest Iowa, Craig Rupp, shout out to Craig. And probably 12, 13 years ago, he said, hey, I think we should start a company in agriculture. And that kind of led me on this journey of starting companies in ag. So first company I started in ag was 640 Labs. That was acquired by Climate Corporation and Monsanto in 2014, strangely enough. Rob was also an investor in that company, and you were our attorney. And then after being there for a few years after the acquisition, decided to start another company and started CamoAg.
Okay. And then Rob, you gave us a little bit about your background, but can you tell us about the Serra family of funds generally and ag? It didn't start in ag, right?
No, it didn't, Galen. And maybe a little bit more about my background, which I want to
Yeah.
into my partner's background as well, which I think is part of the ethos of Serra Ventures. So I've been in venture capital since about 2002, 2001. So quite a long time. Prior to Serra, I helped start the Illinois Ventures Group in Champaign, their first venture program in the early 2000s with the goal of commercializing technology that came out of the university. So kind of an innovative program focused on kind of the research that came out, and we started some exciting companies that came out of that program. But prior to that, I was an entrepreneur. So I did a couple of stints as an entrepreneur. The latest is I helped found a company called Digital Work in late 98, 99, kind of during the .com boom. So have been around for a few technology cycles, which is valuable from a context perspective as a venture person. So I started that company from scratch. The vision was internet was just taking off. How could we bring kind of big company services? Back then, you think of a website, email marketing campaign, press releases, things we take for granted today, but back over a AOL dial-up modem, it was kind of challenging. So it was maybe early days of SaaS. We charged a subscription fee, and that was an exciting journey. We raised quite a bit of venture capital funding from some well-known names like Draper Fisher Jurvetson, and took that company through an IPO process in early 2000s, led by Lehman Brothers, which I say that and people chuckle. Maybe I'm dating myself. And then the NASDAQ crash happened, which maybe the viewers here are too young to remember that, but that was pretty dramatic. And we had kind of our first technology downturn cycle that we kind of managed through and found a soft landing for the company. So a lot of entrepreneurial experience. My other two partners, Dennis Beard and Tim Hare, are also former entrepreneurs. So they've run various tech companies. And Tim, I actually met. He was my first investment out of Illinois Ventures. So as a partnership, we've known each other for about 20 years. So the Serra team kind of brings this background of entrepreneurship, which enables us to kind of bring value beyond the capital. We love early stage investing, as we'll talk about more later. But to really do that well, you've got to get in the mindset and coach entrepreneurs, which Corbett and I have some of those sessions from time to time. So that's a little bit about my background and Serra Ventures.
And then
How
Rob,
about? Oh, sorry. I was going to ask about ag and how you came to ag.
Yeah. So sorry, I missed that part. So we're a small early stage fund. So we got started in the Midwest. Our initial thesis around our funds. So we've got three major general funds, total about $175 million under management. And our thesis was around kind of the emerging Midwest tech ecosystems. So we started there, and built three funds around that regional strategy. As we contemplated our fund 4 as a partnership, we said, kind of look back and say, where do we think the puck's going? What's exciting to us? What do we believe in? And we had ended up making about 10 investments in our general funds in what we would call kind of the AgTech sector. As Corbett mentioned, I think we were the only venture investor in 640 Labs, because everybody else is like, what is this ag thing? So we did 10 investments, and not only did we had some degree of success from an exit perspective, but we learned a ton. And I think developed at the time a pretty unique point of view on where we saw kind of the ag food ecosystem going, and got pretty excited about doing a vertical fund in that category. And so we raised our first AgTech fund. It was a $45 million AgTech fund. We did 21-ish investments, out of that fund, tended to focus in the kind of seed early growth stage. That led us into the AgTech sector, and we can talk about it more later, but super excited. It was the right play. We can talk more about our thesis in a bit here, but maybe the commercial here, we're in the process of kicking off our second AgTech fund, and we're super excited about that.
I'll just flip back to Corbett now. So I think on a related point from the entrepreneur's perspective, how do you see the ag market? How big is the opportunity? And then, what is CamoAg, doing differently in that market to set itself apart?
Yeah, so depending on how you measure it, right, the ag market is a pretty significant part of the GDP, at least in the United States. But if you think about it in the world, everybody's got to eat, right? And where's that coming from? It's coming from a farm. In terms of the United States, if you look at just GDP contribution, you're probably looking at somewhere around $1.5 trillion when you include direct farm production and then food and all the downstream processing that's happening. Other interesting stats, you've got about 2 million farms in the United States. And in terms of people like directly involved in labor on the farm, probably around 3 million people. So it's a big industry. And I would say the average person walking down the street or the average entrepreneur does not think about doing something in agriculture. I think most people are off chasing some new AI, random social network thing or whatever. But I think that leads to some really interesting opportunities in agriculture. It's one of those dusty industries that most people don't pay a lot of attention to, but yet is very necessary to sustaining life, literally.
Definitely.
Corbett, one of the things that I think, at least initially, whether, when you think of ag tech and farmers, I know you said you don't sell to farmers. Do you feel like there's a level of sophistication in the ag industry that's on par with others? Or it's, geez, we're doing things that other industries were doing in the 90s? I could ask that question about, I always joke when I meet healthcare entrepreneurs or investors, I'm like, someone's not doing that already. It kind of scares me. But tell me what your sense of like how advanced the technology in the business industry is on the ag side.
Yeah, what's interesting, I think this applies to healthcare. It applies to a lot of different industries, but there's really kind of two sides to the coin, right? On the one hand, there's a great deal of technology in agriculture, right? You've had the adoption of GPS for self-driving tractors. That's been around for 20 plus years. You've had very advanced chemistry and biology and genetic breeding, et cetera, GMOs for a long, long time, 20 plus years. I would say on the business practice side, or actually the act of running a company that's selling to farmers, if you dig into the financials of any of these big companies, you would say that they're underspending today on IT or software in general. So there's a lot of headroom for growth over the course of the next 5 to 10 years, just as I think every company at some level is a software company, right? I mean, whether it's a law firm, a tractor company, or somebody breeding seed for farmers, you have to use technology. But in general, it is a bit of a laggard industry, but not universally that way. There is plenty of examples of very, very high-tech solutions involving software and electronics that farmers are using.
I've got another question, Evan. I don't want to monopolize the show.
Yeah, if you got one
Sure.
more, Galen, go ahead, and then we can take it over to the fundraising.
Well, yeah, I was gonna ask Rob. I do want to get out there for the audience, sort of some bellwether, some data points on, hey, if you're thinking this, talk to Sarah. So revenue, if there's pre-money valuation sensitivities, I always think those are good things to affix in people's minds without creating hardened rules. But I'd love to hear you talk about that. And then the other thing is, I love my multi-point questions. When you look at all, there's the companies you invest in, and I'm sure you look at many more. Are there themes that jump to mind when you're on the ag tech side, right? Like, is it, everything's organic nowadays, or everything is about sourcing? I'm just curious, what you're seeing anecdotally.
Yeah, good question. I'll start with the second question first, because that'll lead into your first question. You got to be careful with those multi-part. Remember us?
Yeah.
We're one-car garages, right? So we can only handle one at a time. So our fund, and what's been great about what we're doing on the ag tech side is is we did build a thesis that was based on some learnings that we had from our prior investing, and made some observations from previous portfolio companies. So we built a thesis with three really major pillars. So this is kind of our first filter, which we kind of look at every opportunity that we see kind of through these three pillars. And we've got some sub elements to that. But we made three observations. One is the changing consumer is kind of one of our major theses. So we're doing more than just stuff that sells to farmers. Let me just say that. So we define kind of the ag food ecosystem a little bit more broadly than exactly what Corbett's doing, although he fits very well into what we're looking at or looking for. First was this changing consumer. So Gen X and Gen Z is now the largest consumer of food. They spend the most money on food in the U.S. This is the first generation that kind of grew up with the internet. They're highly teched, and they have got different attitudes and preferences towards the food system in general. So things like they're more concerned about food safety, what ingredients are in their food, transparency on those ingredients and how were they grown, for example, are now attributes of how they make food buying decisions. And if you think about that in general from a consumer perspective, because as Corbett meant, that's what the ag industry is about. It's about feeding people. CPGs are thinking about their business and how they market and how they think about their supply chain a little bit differently. So that requires digital technology. This isn't something a farmer can fix or a retailer or a CPG. There's going to be some regulatory issues. There's going to be sustainable differences that technology is going to be required to make that happen. The second is this changing farmer concept that we kind of articulated, and we're experiencing. Corbett knows this. In fact, I might have got our slide out. Data from you is we're now experiencing some of the largest turnover from a generational turnover in land. About 40%, and Corbett, correct me if I'm wrong, over the next several years or decade, we'll see a transfer from an older generation to a newer generation, either in terms of land ownership or farms. Most people don't know this walking around either, but most farmers don't own their land, so they rent it. So that younger generation, Galen, imagine you take over your grandpa's farm, you're going to come in, you're used to using technology. You're going to think about technology solutions to make your farm or your land more operational, which is a catalyst for adoption of technology and new startups. The third is a changing climate. Now that we're investing only in climate change, but being more mindful of resources, either through robotics or labor efficiencies. Sustainable farming would fit into that category where it fits. Better stewardship of the land. You can't think about climate issues. It's a close cousin to ag related issues. So we're looking at kind of crossover between climate and ag related opportunities as well. So that's our thesis at a broad level, where we're placing our bets. It's funny, you used to be able to say Series A, Series C, but that's all kind of changing these days. I'd say our sweet spot is looking at companies that are kind of $500,000 to $2 million in revenue. So that gives us product market fit, gives us a decent customer stable where we can do some diligence on. We'll write between $1 and $1.5 million first checks and $3 to $5 million rounds of funding is really our sweet spot where we want to play. Typically, we like to lead. When we don't lead, we like to at least be on the board as an observer, so we can add value. If you're not kind of in the cadence of the company's day-to-day thinking and decision making and issues, we can't be as useful as we think we can be. So that's where we tend to play. We'll color outside of those lines, a bit, but that's kind of our sweet spot.
And then Sarah's running an accelerator with companies, or has in the past run an accelerator. I've met companies from all over the world.
Yeah. So now when you think about our funnel and how do we source, opportunities, I think we've got one of the best ag tech networks of any of the firms. Of course, I think that, but So we're co-investing with large AgTech syndicates. We are connected to accelerators. For example, I was keynote a couple months ago at the Purdue Dial AgTech accelerator. We have partnered with a group called Generator. They're in the business of doing accelerators as their business model, but we've partnered with them very closely. In fact, Jack Mark, who's the director for that accelerator, is in our office, and so that's our exposure to really early stage stuff. We sponsor it. We invested in it. 2 of those companies. So Jack's saying 1,000 seed stage or concept stage companies that come through the accelerator. They make progress. We keep close tabs on those businesses, and 2 of those have made it into our general fund.
Okay.
Yeah, I was just going to say, stepping back from the AgTech fund for a second, Sarah has raised several funds across the last couple of years. So, what do you think contributes to that success when it comes to being able to raise fund after fund?
Yeah, well, we raise money just like our entrepreneurs do, so we've got to have the metrics, and business model in place that's attractive to LPs. And I think we've done that. From a management team perspective, we're all former entrepreneurs and know how to work with startups and add value there. We've got a track record of being able to source deals very effectively, pick winners. We've had some nice exits, so our return numbers, although they're not quite where we want them to be. Maybe another topic later is the M&A market and its effect on venture. But we've got great testimonials from our entrepreneurs in terms of our ability to add value to our companies to get outsized returns for our investors.
Yeah, I think it's probably similar advice to what's applicable to the company side. And on that topic, Corbett, CamoAg just recently raised a Series A from a couple of investors. So can you talk a little bit about that and learnings from that process and maybe anything you'd wish you'd done differently?
Yeah, so just in terms of investors and just building on something Rob said, obviously I've worked with Rob twice, so I think certain firms definitely build a reputation, amongst founders, and Serra Ventures has a very good reputation amongst the founders. So, like one piece of advice I would offer, founders is, do reverse diligence on your VCs and ask other founders what the VCs are like in the boardroom. Are they available? Will they truly be helpful? In terms of just other general pieces of advice, especially once you reach a certain level, I think you have to be kind of stingy with your time. VCs are going to reach out to you very, very regularly, and they will talk your ears off even if you're not raising. So I would, sorry, Rob, this doesn't apply to you, but I would be really only talk to the VCs that you genuinely want to talk to, that you think are a good fit for your firm, because otherwise you can spend all day talking to VCs if you really wanted to. And then the last thing is really try to understand the thesis of the investors. Like what are they looking for? So for example, when we were talking to Rob and Sarah, I knew they had a rich history in making ag investments, but is the firm that you're talking to, do they have a track record of investing in this market? Those relationships and that experience is really going to help you as a founder. So I think it's very, very important to not just take any investor as an investor, but take an investor that really can help you for your market.
Hey, one of the things that comes to mind for me and may be appropriate for a call where we have both an investor and a founder. I see, I sit in a lot of board meetings, just like both of you do, or certainly Rob does. And I work with a lot of founders, and I'll meet founders that are like, if I could just get so and so VC to invest, all my problems would be solved. And then I have VCs that invest and really kind of try and take control and do these things. And I have this theory, and there's always outliers to things, but it feels sometimes like the best view of the world is, look, founder, your job is to run this and take guidance and support from the VCs, and that the VCs are there to provide guidance and support and rails. I'm curious, when you guys hear me say that, do you agree with that? Do you think, no, does it vary by stage? Can you just talk about the relationship of the role of both a VC and a founder in, say, a Series A stage company? Maybe that's too open-ended, but I'm hoping you get what I mean.
I can take a rip at it. Look, I think you're right, Galen. It ebbs and flows for sure, and I think it also depends upon the relationship that the investor has with the founder. So I think good investors can go deep in the weeds to help solve a particular problem that's maybe experiential based. I mean, you always expect your company to have more domain knowledge than you would ever have. However, there's a lot of pattern recognition, right, in problems across different companies and different industries, and your own entrepreneurial experiences. So, knowing when to kind of stay out of your business. So I'm not bugging Corbett, for example, but knowing when to roll up your sleeves and dive down deep and help solve some problems, whether or not that's an HR issue or downsizing or recruiting or order of operations. So you got to have enough experience to be able to help out, or also admit where you can't help out, and don't try and get over your skis or offer advice that you don't have any good experience or background on right now. I think that kind of makes up the best boards where, and maybe different board members will bring different things to the table in terms of, what should a SaaS business model look like, or financial presentation, or what have you. But I think it does depend on situation to situation, but it also ebbs and flows depending upon what the needs of the company are at any one point in time.
Mm-hmm.
Yeah, I guess to just build on that, I mean, your investors are, potentially going to be your best introduction to the next round of investors. Typically, your VCs are going to be way more well connected than you are to other investors, and you're going to be able to use that credibility to get meetings, for subsequent rounds. The other thing, just in terms of the relationship between the founder and the investor, for me and like for my style, we've been very much just an open book with our investors, very very transparent, and pretty much without exception, our investors are pretty experienced, so they have not been overbearing at any time and kind of telling us what to do. Now, some of it is, I'm not the youngest founder in the world out there, so right, like I've got a few gray hairs myself, but they're just that dynamic of there really needing to be a good fit between the founder and the investor. I mean, literally just a good personality fit. I just don't think you can emphasize that enough, because if you don't have a good fit there, man, it's just not going to work out well.
Yeah, let me add on to that again. I think what Corbett's saying is like more important now than ever. And I say this kind of in a good way. When we were kind of in the go-go where capital was easy and free to get, venture capital and funding was almost this game of hot potato where you'd fund, and then a couple months later, the Series B investor would kind of jump in, and if you were the seed investor, you might write off and go do your next deal. And obviously, we've gone through some hard times over these last couple of years with multiples coming down and interest rates being up, funds being tougher to raise, and so we saw a lot of cuts and value when companies raised at a higher valuation and capital became more constrained. It's like, oh shoot, we've got this high valuation. Now we've got to kind of accomplish twice as much with the same capital we have. I'm saying that more generically. So your board and the relationship, and your boards are staying together more. You might be allocating more. You might be working harder at the right times with your entrepreneurs. So these softer issues that Corbett's talking about, you're kind of with your board isn't changing as much, at least hasn't over the last couple of years. So it's kind of like, I've been in venture for 20 years. It's kind of like it used to be to a large degree, where your board is kind of a part of the team. So if you've got some rough choices that you made on your board, it's not changing. It's not changing as fast as it used to. So it's really come kind of more a part of the team, which wasn't the case necessarily kind of between 20 and 22.
Mm-hmm.
Yeah, just to vamp on that a little bit, and especially given the market conditions of the last couple of years, for any founders out there, thinking about who to raise money from, your investors can make your life wonderful and enjoyable and uplift you, or they can make your life a living hell. And but it really comes down to, it's a relationship, right? And nothing is going to go as planned. Everything's going to take, twice as long as you thought. Everything's going to be a lot harder, right? And just having investors that you can call up and really have a very candid, open conversation with is really important, right? You do not want to be dreading that conversation with an investor. The day that you get to that, it's like, man, you probably chose the wrong investor. So I just, that fit between the founder and the investors, super important. Cannot emphasize that enough.
Yeah, it's funny. When I was an entrepreneur, one of my advisors told me, he said, choose wisely your VC, because it'll be easier to divorce your wife than it will be to get rid of your investor.
Yeah, over and above valuation, of course, right, Corbett? I mean, that's the other thing. Young entrepreneurs are push valuation, and that may be some circumstances the right decision, but in others, it's just not optimizing for the right thing. It may end up in, like, I think, a lower present value valuation of what they're really trying to do, big picture.
Yeah, I think people can spend just way too much time thinking about valuation, and it's not really the thing that's going to drive the company forward and make it successful. So no, you're right. I mean, I would choose a lower valuation with an investor I liked over higher valuation with an investor that I just can't stand.
Could you guys talk about the balance between, like, here we are in the Midwest, and there is a vibrant venture community, and venture at its core, I always joke my grandfather would have a coronary if he saw the legal things that these small businesses go through, and all the things we think about in the detail and how perfect it is. But these are businesses designed to go through successive rounds of diligence and ultimately sell for what ideally is a very large number, right? So it's worth it to pay at least some care and attention to those things. But in working with both of you, you can really pour the gas on, and maybe you do have to get these high valuations because you're just dumping the gasoline on growth versus a more measured growth. How do you think about those things? And do you think it's different here in the Midwest, or maybe different in ag generally, or within ag, there's people trying to blow the doors off and they have a higher likelihood of wiping out? Could you talk a little bit about that?
You want to take that, Rob?
Yeah, I'll take it. I mean, sure, everybody wants to grow as fast as possible, right, Galen? And I don't think you'd walk into any entrepreneur or any VC that says we don't want to grow fast. I mean, we all know the triple, double, that old
Yeah.
adage. The hardest part is in early stage investing and being an entrepreneur is how much do you want to spend to figure that out? I mean, you're only going to grow super fast when you figure out your unit economics and how to hire salesperson 3, 4, 5, and 6, know what their quota should be, know what their close rate should be, can train them very well and you've got really tight product market fit. So the hard part is figuring out when to step on the gas. And then that's got to correlate with a financing window to figure that out. Because if you burn the flame too fast at the beginning and capital's tight like it is now, you're going to run out of money too soon. So it's I use the word pattern recognition again. It's a pattern recognition game, and understanding the resources you have and when the right time to scale is. In fact, Corbett, you and I were talking about this yesterday.
Yeah, I guess, Galen, to answer your question, I think ag is a little bit different than perhaps other industries, and for sure the Midwest is different, just in terms of investors, dollars that are put to work in startups and so forth. But it's not, I don't think that you can just look at any of the metrics that, let's say, are coming out of California or whatever in VC investing and say, okay, well, we should be able to do that in the Midwest and be able to do that, in agriculture. I think as an industry, there are just some certain aspects of the business that cause it to not scale as fast as, let's say, a consumer market. But that being said, there's a lot of money changing hands in agriculture, right? It's an industry that is not going away, and there are plenty of opportunities for injecting technology into this space. So it's, but I think you do have to be a little bit careful and say, hey, a playbook from another industry is going to work well in agriculture.
One thing we've talked about a couple of times has been the shifting venture landscape. And I think one thing Galen and I have certainly seen is more bridge rounds, more follow-on activity. So Rob, a question I have for you would be, have you seen the same, and has it necessitated a shift in, Serra's strategy at all?
Seed 3, 4, and 5.
Right.
Totally.
Yep.
Yeah. I totally see it. A lot of extensions, safes, bridge rounds. It has been a trend for sure. And what it does cause you to do is obviously when the world was changing, we weren't alone, but a lot of venture capitalists would kind of relook at their allocation plans, kind of dry powder plans for their existing portfolio, and just kind of bunker in and know this is going to take a little bit longer than you expected, and allocate a little bit more, and need to work a little bit harder than maybe you did in the free and easy capital days. So yeah, we're definitely seeing it. And again, I don't think it's necessarily a bad thing. I think what correlates to reserving more and investing in milestones before a next round of capital is that the VCs are working a lot harder on their boards. I think boards are tending to be more productive and engaged, and really businesses are being built better. I mean, if you go fast, that doesn't mean that the wheels won't fall off at some point in time. I think a lot of kind of blocking and tackling things are being paid more attention to in terms of, product market fit has got to be super solid. Unit economics need to be super solid before you think about investing in customer acquisition growth. So I think coming out of this, we'll see better built, businesses that maybe just took a little bit longer to get there, and sometimes a safe or a extension round might be needed to do it.
No, I mean, the penultimate topic that we usually go to on these podcasts is challenges. So I was going to kick it over to Corbett for, any war stories that you have, either from CamoAg or from, being a founder generally.
Oh, I've got a few. Yeah, I think, just in terms of war stories on my side, we had originally started out as a marketplace, and as time went on, it just became apparent that the software platform that we had built, that really turned out to be the crown jewels of the company. And then we pivoted into more of a vertical SaaS software business. So obviously a lot of soul searching went into that decision, right? And feeling comfortable to maybe say the original idea wasn't the right one and move on to something else. I know, Galen, you've asked me a few different times, hey, was that a hard decision or not? And yeah, it's always a hard decision, right? To make a switch from an original idea to where the market is actually leading you. So that's probably my biggest, kind of war story of challenge and soul searching around doing a
Corbett,
pivot of the business.
Could I push you a little bit more to talk about, and if you can't think of anything, but that's fine. But that pivot really impressed me, and part of it was because I was there from day one. When I heard the name of the original company, I thought that was so cool. So I was really invested in it. I think personally, it was hard for me when you said we need to do this other thing, to say, well, wait a minute, it's just around the corner to do this other thing. I know it'll work. And I think for any entrepreneur, there's this impossible balance between running through walls, almost naivete about what other people tell you can't be done, but you're going to do it because it's just over the corner. And then knowing this isn't working, but if I just shift here. Was it talking with board members? Was it just looking at the metrics? How did you finally decide to do it? Right. And to be fair, I remember when you told me the new name, I was like, it's not as good as the old name. I love the old name. I really struggled to go on the pivot with you. And here you are, you're making that Kool-Aid of this company, and you're able to make that turn first. Right. So I'm curious if you could tell us a little bit more as to how you brought yourself to the decision to do it.
It really came down to simplification, right? I think so many startups, as time goes on, you do this and then you do that, or you've got product line A and product line B and product line C. But eventually you've got to figure out how do you simplify the business? How do you have a singular focus of where you're headed? And it's very challenging. The other, for us, the other reason around the name change as we did the pivot was the prior company was known as a marketplace, right? And we were successful in that. We were extremely well known, and we knew that it was going to be hard to escape what we were known for. So I don't know, Galen. I mean, it's just, I think there are probably 2 to 3 big decisions you need to get right every year, and putting the time and energy into getting those decisions right, and then just go. I mean, you've got to at some point burn the ships and just go. So yeah, you never. The way life plays out, the way startups play out, you rarely get the opportunity to take both paths in parallel, right? You have to choose one or the other and commit. And obviously, I started telegraphing this to the board fairly early, and I had good support. And it definitely was not just a decision on my part. It was a board level decision. But the board understood the rationale, and they believed they believed what we wanted to go and do. So, the other thing too is just not that any company is easy, but vertical SaaS or SaaS businesses in general, they're not as difficult to pull off as a marketplace. So I think there must have been at the investor level a certain amount of like, yeah, that makes sense, or kind of like, geez, we're glad you came to that conclusion as well. But it is no business is easy, but a SaaS business is just naturally going to be easier to scale. And today for vertical SaaS, that the vertical SaaS area in terms of valuations has held up pretty well through this kind of overall downturn. I think a lot of people are realizing that vertical SaaS is a pretty hot area, and we'll continue to see pretty healthy numbers from an investment standpoint.
Rob, any good war stories? Any amazing pivots that you?
Yeah, well, we're in a war right now, Galen. So
Yeah.
yeah, this is a tough time for the venture capital industry, for sure, from a number of perspectives. Obviously we've seen the IPO market basically disappear. Not that we've got a lot of IPOs in our portfolio, but it's a leading indicator. We've seen comps in terms of multiples come down 60%, off their highs, the public markets, which again, it trickles down, right? So any private company is going to trade at a discount to the public markets. And then just an overall lack of liquidity, over the last couple of years. Venture funds are 10-year funds. When you take basically 2 to 3 years out of that life cycle, it creates challenges, liquidity challenges, not just at a fund-to-fund level, but in an industry perspective. So just to keep it simple, if we're not getting money back to our LPs, whether or not they're individual investors or state institutions, that capital is not going back into the industry. A lot of LPs will say, yeah, once you return some capital, I'm happy to invest in your next fund. So this lack of illiquidity has really clogged up the system. And I know there's a big focus on that. So that's kind of, so that's changing things a lot, in our industry, and a lot of VC firms won't make it, through this cycle and this tough period of time. And then on the other hand, of course, you hear VCs always say, this is the best time to be investing in startup companies. I mean, multiples are down, innovations just continue to happen. Ag overall is, we're getting an education, new industries as they emerge take years of education. We're seeing super smart people that are blowing off their Google jobs or Microsoft or Tesla jobs and are going to solve problems, in the food ag, because those are the biggest problems that are, mission-driven problems. So it's a great time to be building an ag company right now. And maybe the availability of VC capital to build new funds is a little bit dislocated. So we'll fight through it, but it's not the first cycle that we've seen. So it's an interesting time.
Yeah, I find myself both citing and taking solace in the I think it's the Buffett quote, right? Like be greedy when other people are fearful, and fearful when other people are greedy. And I do see that there's good deals happening now.
Well, and just to build on what Rob said, I mean, like, I know VCs are here to make money for the investors and stuff, and that's all cool and stuff. But really, for the founders are here to innovate and do cool shit, right? And I just can't imagine a more magical time to be out there building a company right now. There's so much capability that's being unleashed in the market that even for startups, it's hard to keep up with everything that's coming at us. So, yeah, I mean, there's the funding stuff may be like not super hot right now, but from a tech standpoint, man, it's an amazing time to be alive. It's an amazing time to be building right now. I it's magical. So that's what makes it all worth it. I mean, fundamentally, we're all builders and we want to build stuff and we want to innovate, and that's what's so exciting right now.
Is also tech talent also Corbett, or no? It's more, you're talking about tools, right?
Well, I mean, literally everything, but actually it's a really good time to be hiring people right now. Tech talent availability is much better today than what it was 2 years ago. It used to be very, very hard uh, to hire people, and that has gotten easier. So yeah, I think that's a general positive thing for anybody that's trying to scale up a company and hire people. It's easier to hire today.
This has been great. Thanks for bringing us together. I think it's a great way to have an investor and a portfolio company kind of side by side. I guess you could tell if there was tension.
I was thinking, I certainly have a lot where I'm like, I couldn't get this combination together.
Thank you for listening to this episode of Venture Best Spotlight.
Please make sure to subscribe for our upcoming episodes featuring our network of amazing founders. And if you like this episode, please remember to rate and review on your favorite podcast platform.